So without any further ado, I'm going to hand it over to Tim Frazier from Conservative for a short introduction. Tim, why don't you take it away?
Yeah, hi, good afternoon, everyone. Thanks for joining. Like Sean said, my name is Tim Frazier, Director of Sales and Marketing for Conservative. So we're super excited to be participating on this and partnering on this panel. Conservative is just a decision support platform. We work with some of the elite professional services firms out there with group purchasing, spend analytics, managed services, and overall success in managing vendors. Enough about us and me. Most importantly, we have our wonderful panel today. So I want to introduce Eric Anderson and Nishant Mittal. Eric Anderson leads the San Francisco Bay Area state and local tax practice of Anderson. He focuses on income tax planning and compliance, sales and use tax transaction planning, mergers and acquisitions, franchise tax matters, and administrative tax controversies. Eric has extensive experience with unitary tax planning, business and non-business issues, and entity structuring to manage multi-state tax liabilities. Eric also serves as an adjunct professor with the University of San Francisco School of Law and has previously taught state and local taxation and other programs. He also speaks on tax topics at seminars including Georgetown University Law Center, Advanced State and Local Tax Institute, and the Institute for Professionals in Taxation. Our next speaker is Nishant Mittal. He's the founder of Moneo, which was acquired by Topia a few months ago. Nishant has led the development of the technology and has 10+ years experience helping thousands of high net worth individuals and several asset management firms be prepared for audits involving day counts. He's based out of Topia's New York City office and currently working from his home in Westchester. So with that, I'll leave it with Eric to take it away from here. Thank you.
Perfect. Thank you, Tim, and thank you all for joining us today on this topic. It is a strange new world that we are in, having everybody working from home during this global pandemic. And because of that, we have mobile employees that are scattered about. So we'd like to start off just taking a pulse of how you are feeling right now on state and local tax topics. So which of the following state and local tax issues is keeping you up at night? Keeping up with city and local taxes, keeping up with the nexus rules, keeping up with payroll and withholding issues for mobile employees, or just keeping up? Everything. I'll give you a minute to answer the polling question so we can just see what you're thinking out there. Okay, Sean, I think let's go ahead and close the poll and let's see what people think.
All right.
So keeping up, all of the above. Well, that's great because there are a lot of changes that are going on afoot, and at the federal level, the state level, the local level, we have so many new things that are coming our way. So I feel everybody's pain. Just keeping up is probably what I would say too. But city and local taxes also made the cut as the second place. That's mostly what we're going to focus on here today. So let's dive into a little bit of introduction of what's happening in the world right now. If you look at the patchwork of our federalist system, the states and the localities each have their own authority to impose taxes at all levels. And because of that, we have to work on and deal with the patchwork of issues that we face when we look at the state and local governments. We look at residency issues of people traveling around and working in different locations, and that may beget personal income tax issues. The home office rule is an issue for people that work in places like Manhattan, where New York has a convenience of the employer rule that may treat you as if you are working in Manhattan, even if you are working in another adjacent state, or even if you've left Manhattan to another place, but you're working for a company that is in New York. What we are seeing across the country is the states are reacting to employees that are coming into the state due to COVID and sheltering in place in a location that is not their home state. That has an impact not just on the employee, but on the businesses. And for businesses, what we're looking at is new nexus, new connections to a state that might create obligations to collect sales and use tax, to collect income taxes. And the states are coming out with rules saying that in some cases, if somebody is sheltering temporarily in the state, that may not be enough to create a connection in that state and create a filing obligation. Many states, however, are staying silent, leaving the question open. Now, in the aftermath of all of this, we don't know if people stay in their new chosen state and companies make dispensation for people to live wherever they want to live, if that now creates new obligations. But what we really want to focus on today is there are certain taxes that are determined and based and computed on the amount of work that employees are doing in particular locations. And many of those taxes are imposed at the city level. So if you look at New York City, San Francisco, Los Angeles, Oakland, Seattle, many other places around the country have these taxes that are in part imposed upon employees performing work in those jurisdictions. And that's what we're going to focus on today, to figure out what are those locations and how do we deal with this new world that might beget some tax savings. So let's go to another poll really quickly. In 2021, I expect our employees or our clients will be working from home all the time, most of the time, some of the time, or rarely. So the poll is now open, if you can answer. What do we think is going to happen going forward now as we come out of this pandemic? Will people still be working remotely, or is everybody going to rush back into the office, or do you think it's going to be some kind of a mixed bag? All the time, most of the time, some of the time, rarely. Okay, Sean, let's close the poll and see what our people said. Okay, so most of the time and some of the time. So rarely is not even an option here. It looks like the world is going to change in some way. So is that going to be people staying at home, telecommuting at times, or doing that much more often? Or now we have all the time where some employees might just be sourced in locations that are not near our offices. And that's going to create this difference in the tax computation for many of the cities that we deal with. So let's look at a few cities. Now, this is representative of many jurisdictions around the country. So if you're looking at this and you say, you know what, I don't have operations in New York, San Francisco, or Los Angeles, this gives you an idea of the way taxes that are imposed that have a payroll factor component to the allocation, or are based in part on work performed in the jurisdiction, how taxes can be changed. So again, representative, but at the state and local level, there are many other jurisdictions around the country where this also may be relevant. But let's dive into a few that are representative. New York City imposes an unincorporated business tax. It is an income tax that is imposed upon trades and professions, occupations that are in a construction that is not a C corporation. So this is partnerships or limited liability companies, fiduciaries associations, or maybe even a sole proprietorship that somebody has that is reported on a Schedule C in their federal income tax return. The tax is 4% of net income allocated to the city. So allocated to the city is the focal point here. How do we get an allocation of income to New York City? Well, the way that is done is based upon work that is performed in the city if you are in an organization that is a service organization. So that can be funds, private equity, law firms, accounting firms, other financial firms, consulting firms, and even my own firm, Anderson, has to deal with the unincorporated business tax and look at where our employees are working. Well, I can tell you our unincorporated business tax was exceptionally high last year. And when I look going forward at what is going to happen due to COVID, there are some ways that we can mitigate that. Well, how do we mitigate that? I mentioned the allocation formula. This is it. Services performed in New York City divided by services performed everywhere. It gives you a percentage. That percentage is then applied against your income that is derived from all sources, and that will be taxed at the 4% metric. Well, think about this. 2 million people commute into Manhattan every day. They come from places all over the tri-state area, and many of those places are outside of the city limits of New York. So people who are now sitting at home during COVID and maybe beyond, and what we see going into 2021 and forward, may be performing their work in Connecticut or New Jersey or upstate or somewhere else that is adjacent to but not in New York City. Well, remember I mentioned at the beginning that there is a convenience of the rule so that an employee may be treated as an employee working in New York City for personal income tax purposes. That does not apply to the unincorporated business tax. The question is, where are the services performed? If somebody is sitting in New Jersey and they're performing services in New Jersey, that is not in New York City. That drives your allocation percentage down. The city has provided no guidance related to COVID-related issues and people sheltering in place. So we're left with that base rule and the base formula. So if we can figure out a way to mine through the data, know how much employees are working outside of the city, your taxes go down. We would expect a significant drop in taxes for many service-based businesses that are paying an unincorporated business tax due to COVID and due to shelter and due to the ongoing stay-at-home workforce. Now let's go to the other coast. This is where I am sitting today. I am in San Francisco, looking out at a beautiful sunny day, which is unusual for us in foggy summertime. San Francisco also imposes a tax. It's a bit different than the unincorporated business tax, but it has some common tenets. The San Francisco business tax is imposed on gross receipts. So you don't have to even be a profitable business to pay the San Francisco tax. That gross receipts tax is a graduated percentage depending upon what activity code you fall under the NAICS system. And that tax can graduate up to 0.65% of gross receipts. On top of that, there is a new tax that was imposed last year to battle homelessness in the city that is imposed on gross receipts that goes up to 0.69%. It is a surtax for receipts that are above $25 million. And then there is on top of that a payroll expense tax of 0.38%, which is an additional tax that is directly on payroll for services performed in San Francisco. Now, the reason we look at the gross receipts tax and we're concerned about that from a telecommuting perspective is the percentage of payroll in San Francisco for compensation for services performed by employees in San Francisco, that percentage determines the entirety or a part of the gross receipts that are allocated to San Francisco and therefore taxed in these categories up to the 0.65% plus 0.69 in some circumstances, as well as the 0.38% payroll tax on services. Now, you may have heard, if you're in San Francisco and doing business here, that there are propositions going on the ballot that are proposed by Mayor London Breed that went through our supervisors and are now going to be voted on by the voters in November. That would take these tax rates up significantly. The 0.65% rate that you see on the slide will go up to 1.04. So many of the other categories will have a similar increase. So we are seeing an increase at the top end of these rates increase by somewhere in the neighborhood of 20 to 40%, depending on your NAICS code. So the problem just keeps getting compounded, or the amount of tax keeps getting compounded and increasing. As I mentioned, the payroll is really a driver of these taxes. You look at the W compensation of employees, plus pass-through compensation of flow-through entities. So owners of flow-through entities that get distributions, that actually counts in this measurement. The payroll allocation is then based upon where people are working. So you're looking at working hours, or for commission-based employees, you look at business transacted in San Francisco. So that would take into account if you go and you sell something to a company in Oakland that actually is not treated as San Francisco work, or based upon a reasonable method given the facts and circumstances. Well, let's think about the facts and circumstances right now. People are working from home. And just like in Manhattan, where 2 million people commute into Manhattan every day, the city of San Francisco's population doubles on a normal commute day when people are coming into the city to work. That tells you that people are working outside of the city due to shelter in place and staying at home. The issue that we have with San Francisco is we have this percentage of working hours, but how do you determine that? And that has been really inconsistent in audits where we're trying to figure out where were people working. It's easy to find a percentage of working hours if you have an HR system that tracks where people are working at every point in time. But a system may track for personal income tax withholding the state that somebody is working in, but it certainly doesn't track if somebody is crossing that Golden Gate Bridge and going and working in Marin County, which is not in the city of San Francisco. So you have to come up with some kind of a mechanism to capture the data to be able to substantiate your number. Our neighbor to the south, Los Angeles, also imposes a business tax. The LA business tax is also similar to San Francisco in that it is imposed upon gross receipts. It graduates up to about 0.45% of gross receipts for professions and occupations. And that gross receipt then is measured by the work performed in the city. Now, unlike San Francisco that actually says there is a time-based measurement, or there is an activity-based measurement, or a measurement based on the volume of business conducted in San Francisco, Los Angeles actually provides no guidance on what work performed in the city means. But if you just think about it intuitively, people that are sitting at home doing work in someplace else that is not within the LA city limits is not counted in the measurement of the percentage of gross receipts that are attracted and taxed by Los Angeles. There is a ruling that LA put out, the City Clerk Ruling 15, and all it says is that you need to look at gross receipts directly attributable to services. Doesn't tell you where the services are performed or how that works. An allocation based on cost. Well, your measurement of salaries is one measurement of cost. So that's how your payroll might come into play here. And then there's this default assumption that 20% of the work performed outside of LA is deemed to be working in Los Angeles. Well, I think now that we have people working more permanently outside of the city and not even commuting in at all, we may be able to challenge that 20% rule. But there's little guidance on these rules related to COVID-related or shelter-in-place related activities. Let's look at an example of what this could mean for businesses. Now, this example is actually derived from a company that I work with. It is a professional services financial firm. The numbers have been changed a bit to make them easier and to understand and to give you an idea of the type of tax savings here, but this is fairly representative of what they have. It's a financial services firm in a flow-through construction, a partnership. The gross receipts of the firm are about $200 million a year, and their payroll expenses are $50 million each in New York and San Francisco, for a total of 100. When you factor in some other expenses, their net income is about 60 million off of the 200 gross. I made it easy. The payroll percentage in this case is 50-50 New York, San Francisco for employees that are working all day, every day in each of those cities. So if you take the unincorporated business tax of 4%, you multiply the 60 million by 50% by 4%, you get an UBT of $1.2 million. If you take the components of the San Francisco gross receipts tax, 200 million at 50% at the relevant rates, for this company, you are getting a tax of nearly $1 million. So they're paying about $2.1 million in New York and San Francisco combined. If their workforce is telecommuting 20% of the time in each of these cities, the savings would be $500,000. If they're telecommuting 50% of the time, the savings would be about $1 million off of those taxes. So you can see it has a dramatic impact. And in this particular case, it has about this number of impact for a company that's paying a couple $1 million between these two cities. Well, those aren't the only other issues. I mentioned at the beginning of the webcast that there are other localities, other states that are out there. So you need to consider other states and localities and the apportionment that those states and cities provide. We talk a lot about the states that have what we call a cost of performance-based apportionment. What that means is a state may view the amount of income that is taxed in a state and compute a percentage of income that is taxed in that state based upon the percentage of work performed in that state. So there are about a third of the states of the US that have that kind of a rule. So this kind of tracking of remote employees may be relevant for a broader base of state taxes and a broader base of other cities besides the one that we've talked about today. One other issue we need to worry about is there are budget deficits. San Francisco has a $54 million budget deficit that they're trying to plug right now. That's why the tax rates are going up. Philadelphia has come out and said that they consider temporary telecommuting employees that are outside of the city as if they are performing work in the city. So they're trying to get ahead of what we're talking about today and say, well, that's not actually that's work in the city, or we're going to deem it so, and that's going to keep the tax base stable. I think that rule is subject to challenge, but it's something we need to work through out there, is how the cities are going to deal with this. And the best way to deal with those kinds of challenges is substantiation. The best information that you can provide, that in the event of an audit, you're able to defend what the city or the state or the locality is going to throw at you to say, no, we think that work should be deemed to be performed in our jurisdiction. So information is absolutely key. And to discuss a bit about that challenge, I'll hand it over to Nishant.
Okay, great. Eric, thank you for that fantastic introduction. Also, thank you to everybody who's been sending in questions. We will be taking questions at the end. So please don't hesitate to send in whatever is on your mind. Eric and I will be addressing all your questions here over the next few minutes. But as Eric pointed out, what is consistent in what you've heard, whether it's New York, whether it's LA, whether it's San Francisco, one of the opportunities here, which there don't seem to be too many opportunities in this COVID world, but there is an opportunity right now to save some city-based taxes. And these are rules that have already existed on the books. And so the question becomes, how do you take advantage of this opportunity? And one of the things that is going to be required, if you go back to Eric's slide, which showed the calculation, one of the key factors there is about the amount of time that people are spending in and out of a New York City or San Francisco or an LA. So how do you capture that information? How do you make sure that you are going to be prepared when an audit hits? Because an audit will most definitely hit. All cities, whether it's New York City or San Francisco, they are under budget pressure, and that is only going to increase because, for example, in New York City, UBT, there's a large part of the UBT comes from financial services firms and from law firms, and to the extent that taxpayers are going to be claiming exemption from those city taxes, the cities are not going to take that on face value and are going to ask for substantiation. And so to Eric's point, I think the question here is going to be, to the extent that you are going to claim these savings, how are you going to be prepared for it? Are you just going to cross your fingers behind your back, or attempt to have the documentation that is going to be required in these audits? Now, these audits, I expect, and obviously this is new, the whole thing around UBT and the number of folks who will be looking for exemptions on the New York City UBT or the San Francisco GRT. But the expectation that I have is that these audits will look very, very similar to residency audits, where day count is at the center of a lot of those audits, where it is the taxpayer's responsibility and the burden of proof lies on the taxpayer to be able to prove where they have been and where they have not been. And so the taxpayer needs to come up with clear and convincing evidence as to how much time they have spent in a given jurisdiction or not. Now, historically, if you have been a part of any of these residency audits or know somebody who's been through these residency audits, historically, what was acceptable to a number of authorities were things around, credit card receipts, or you may have flight records, or you may have a calendar that you may have kept, so on and so forth. But a lot of those things become increasingly difficult when you start to think about city-based taxes, because when you have, a flight record that you may have, it may show that you have flown from New York City to Texas, or from San Francisco to Texas, but it really is not able to help you establish whether you are in San Francisco or you're in the Bay Area, if you're in Westchester or you're in New York City. And so a lot of those kinds of traditional data sources are unlikely going to be sufficient and are going to leave large gaps in the proof that you will need to submit in the event of an audit. Also, in the more recent years, taxing authorities, especially in states like New York and California, have been extremely aggressive and have been going after cell phone records, for example, subpoenaing records from AT&T and Verizon and other such folks. So we see governments using a lot of technology. The dollars here are going to be meaningful from a UBT perspective, from a GRT perspective. And so my expectation fully is that the cities are not going to leave any stone unturned in terms of being able to figure out whether the allocation that you're doing is correct or not. So the question that comes back to us as taxpayers is, as we look to claim these savings in UBT or GRT, then how do we prepare ourselves in these audits? And the question becomes, do we use technology? If the government's going to use technology, what is the best answer we can provide to that is basically through using technology. And luckily, technology is available today to be able to help taxpayers through these issues. Now, there are a number of different ways this data can be collected. It can be collected through applications that can be deployed on many different kinds of devices, such as mobile devices using the GPS functionality, whether it is on laptops with Wi-Fi technology, whether it's by using VPN records or mobile device management records that your IT teams may be keeping. There is essentially technology that is available that will allow you to keep a good trail of data that you will need to prove whether the individual on behalf of whom you are claiming the UBT savings or the GRT savings was indeed in the city or outside the city. All of this information, when aggregated, can provide both visibility to the employee, so that to the extent that they need to manage how much time they are spending in and out of cities, or to the organization, so that you can manage the tax exposure that you have or the savings that you are trying to claim, that you are able to do that. Now, one of the side benefits of being able to use this kind of technology, and as Eric pointed out on his first slide, in the current environment, not only is there an opportunity for enterprises or firms to be able to save on city-based taxes, but we also fully expect that a number of partners, a number of other individuals are probably considering moving out of states like New York, like California, and re-domiciling in other states, in no-cost or low-cost states. And so that becomes a side benefit of using technology that partners can use this kind of information to be able to defend themselves in those residency audits as well. And then ultimately, all of this information you will need as backup when an audit does happen. These audits, I've been part of several of these audits at an individual level where people have to prove how many days they have been in a given jurisdiction. Can be very, very painful, can be extremely prolonged. So if that is true for one individual, when we start to think about a group of individuals, whether it's 10 or 50 individuals, the complexity of those audits is only going to go up. And because the burden of proof lies on the taxpayer, and it is on the taxpayer to provide that clear, convincing evidence, I expect that these audits will be both very time consuming and expensive. So with that, I'm going to pause there and see if we have some questions. Eric, maybe I can get you started with one of the questions that has come up here. Just give me 1 second.
Yeah, that's great, Nishant. And I've also been typing in some of the answers to them. So, but if you want to go through and ask them, then we can address them for the whole audience.
Yeah, I think that'd be great, because we do have a bunch of questions. There's some really good questions that are coming through. And so it may make sense for everybody to hear some of those answers. So one of the questions that I see here is, what about someone that works in New York City and has been subject to New York state taxes, but is now working from their home in New Jersey? We are currently withholding New York state taxes, but will New Jersey want to claim those taxes? So we now need to withhold New Jersey state taxes as well.
Yeah, so that's a great question. So there is New York does have the convenience of the employer test. So if the employee is tied to New York City, then New York and New York City would claim that that is work performed for the convenience of the employer in New York City, and therefore still a New York wage. New Jersey, among other states, has come out with some guidance around COVID, saying if somebody is merely sheltering in place temporarily, that they're not going to consider that to be New Jersey activity merely because of the pandemic and having them stay at home. There's also some agreements between the states and the tri-state area. So I think in this case, it would still be New York City wages for personal income tax purposes, unless the employee is staying at home and continues to stay at home permanently. Then the temporary nature of them being in New Jersey may change, and you may put their tax home to New Jersey. I'll contrast that with the New York City unincorporated business tax, or the way that you would prepare, if you're a corporation, the way that you would prepare the corporate return, where there is a payroll component of that that drives some of the income to the city. I would treat the person as a New Jersey employee and the work in New Jersey as New Jersey for the unincorporated business tax, because those two tax rules do not align with each other, and I think you can take different positions for them.
Yeah, and that's a really good point, Eric, that on the UBT, that convenience of the employer rule, at least for the previous guidance from New York City, does not apply. And so even if you have somebody who's temporarily working from New Jersey, you can allocate the apportionment of that away from New York City. So thank you. One follow-up question on that, Eric, if you want to address some folks asking here that, hey, I may have somebody who's working from New Jersey, but they are still going to be logging into the servers in New York City. Does that mean that I can still allocate the UBT outside of New York City?
Yeah, there's a famous tax case in New York where a trader who worked on Wall Street actually moved to Philadelphia and was doing just that, was working in Philadelphia and logging into the system in New York. And New York said, well, it's still a convenience of the employer. They're still tied to the New York office, even though they're now living, a second state away, not just across the river, that they're still treated as a New York employee. Now, again, that was for personal income tax withholding purposes, to figure out whether or not the person was subject to tax on their New York wages for the work that was being performed. It really still does not have anything to do with the unincorporated business tax or the allocation percentages for the business itself. So it's a good question, because that case is out there. And maybe that's where the question is derived from, and it does create that tie to New York. So you do have to be concerned a bit about that. What we have seen going forward, however, is that case we think is a bit of an anomaly. I actually teach it in my graduate law program at the University of San Francisco Law School, because it is somewhat an outlier if you look at the way the convenience of the employer test is constructed. That seems to be a real stretch, that just because somebody is logging into a server, it brings you back into the city. So I think it's subject to challenge, but for the business tax side of things, that I don't think matters. It's really, you have to look at the convenience test. Now, one thing that is unique in that case, and sorry to go on about it for too long, but one thing that is unique in that case is that this person necessarily had to be operating on a system to be able to trade on a trading platform, because he was actually doing remote trading. I think that is different than if you're merely logging into your files remotely from your computer, because that server could be anywhere. It could be in New York City, it could be in Virginia, it could be in Gibraltar. It doesn't matter. The server location seems to be incidental at that point. So I think there's an argument there that maybe it's not so connected to the city.
Eric, would you also agree that New York State and New York City treated differently? New York State still uses a three-factor apportionment test, whereas New York City is only using, for UBT purposes, only a single-factor test, which is where work is performed for New York City. And then for New York State, you have the three-factor test, which includes property. And so, even though New York State, from a UBT perspective, if you apply the single factor test, then these servers are basically a non-factor.
Yeah, well, New York State. So there's a bifurcation between New York State and New York City. New York State, for income tax purposes, did switch to a single factor, and where work is performed is a key component of that factor for a service-based business. In some cases, there's a nuance there because they went to this market-based sourcing, which means you look at where your client is, not where you perform the work. But some of the rules make it still sound like where you perform the work is relevant. So that might be a little bit too granular to go into now. In terms of New York City, though, there is still a three-factor that the city imposes on corporations, not UBT, but on C corporations. So Nishant, then that does become relevant to the C corporation, where the server might be in the property factor that is combined with the other factors, but where the work is performed would still be outside of the city and would give you a better answer.
Right, but UBT, because that is not applicable to C corps, but on partnerships, you basically have the single factor test, right?
I'm sorry, what was that, Nishant? Say that again.
Because the UBT is only applied to partnerships and not C corps, hence no three-factor test.
That's right. No three-factor test. It is only a single factor. It's C corporations that have a multi-factor, but where the work is performed is still relevant. It's just combined, so it's a bit less relevant.
Okay. Could take on another question here. So I can take this one, I guess. How are states able to identify out-of-state employees coming and living in their state? So at least in my experience, what we are finding, states, especially aggressive states like New York, like California, they know that there has been gross non-compliance with out-of-state non-resident workers. And so what we are seeing is an increase in the number of audits that the states are issuing. It is obviously very difficult to keep track of every employee coming in. And so to be able to address that, states like New York and California have found an easier way to get compensated for the amount of time and the work that is done by non-residents in their state, which is to go and audit companies and firms. And so we are now seeing states like New York, California, sending a lot of inquiries to firms and to companies, and we only expect this to increase. So to the extent that you are going to be allocating income outside of New York City and San Francisco, and you've historically not done that, then you should expect to get an inquiry letter from the cities. So that sort of is how states are going about it. It's it's very cheap for them to print out a piece of paper and send an inquiry, and then it basically shifts the burden onto the taxpayer to now prove that the stance that you've taken is you can actually support the stance that you have taken. Eric, did you want to add anything to that from your own experience?
Yeah, I think an auditor that is auditing one company is also looking for other companies. So they may get a vendor list, and that's how they identify who the service providers are, who's selling anything to the company, and then they hand that over to their Nexus police, who then send out the inquiries that Nishant is talking about. So the other thing that we've seen is just a pure phishing expedition, right? Just sending out inquiries and trying to find things. I did have a really interesting one. It has nothing to do with service providers, but I'll tell you just how aggressive the states are getting. I had a client that is a perishable goods seller. They sell mushrooms, and they were rolling their truck through New Jersey, and the state trooper pulled over the truck and it told them that they could not have their truck back and they would not release it out of custody because they are not registered for New Jersey income tax purposes. And they held their truck until they registered with the state for New Jersey income tax because they were rolling their truck through the state. So that may not have a lot to do with you, but it's a strange story, and it tells you that the states are really looking for people.
All right, let's take a California question here. If the business is based in San Francisco, the employee lives in South Bay, let's say Los Altos, And then since the pandemic started in March, the client actually does not foresee folks going back into the office for another few months. Then would the city of San Francisco consider those 6+ months to be work performed in San Francisco?
Yeah, so the rule is where services are performed. That is the rule, quote unquote. And there is no, I think it is, at the end of this inquiry, it was, I'm not sure they published any criteria or guidance on this. No, they haven't. But the rule has been that for a long time. So if somebody is based in San Francisco, but worked from home in Oakland, or worked from home in Los Altos, or wherever it was outside of San Francisco, that counts and has always counted as services performed outside of the city. The challenge is getting the data to be able to show that. And for companies that have employees that may have worked remotely on occasion, maybe they didn't go through the drill to do that. Now that we have employees that are working outside of San Francisco much more significantly, sheltering in place in their homes wherever they are, if they're performing their duties, their job duties there and getting paid for it, that is compensation for services performed outside of San Francisco. Yes, it counts. Yes, we need to track it. And no, the city has not come out with any guidance, but I don't know that the city could say that would be work performed in San Francisco, because the ordinance says what it says: services performed within the city limits. That is not services performed within the city limits, and that should count to reduce the allocation factor.
Okay, we have another one here. It says, what have you seen companies do as far as internal policies when it comes to employees moving out of state to work remotely?
You know, this is a great question, and in fact, I'm working with two technology companies right now. We actually just finished one of them on their policies for remote work, because there are a few different facets to that in terms of, if you have an employee working in another state, should they be treated as a tax resident of that state, and does the company then withhold taxes in that state that they're working in, or do they not if it's only temporary? Does it matter if it's temporary for COVID or if it's going to be temporary for some other reason? The rules are fairly strict around this. If you look at the states and what the withholding requirements are for employers, the rules are kind of all over the map. The majority rule is any work performed in the state for which you pay somebody, you have to withhold personal income tax on that person if they are present in the state working. That is California's rule. That is most of the other states' rules. Some states have a threshold on it. New York gives you 14 days before you have to actually start withholding taxes, and on the 15th day you would have to. Hawaii and Illinois give you, Illinois gives you 30 days. I think Hawaii also gives you 30. They may be 60. Oklahoma, very charitably, gives you, if an employee is there for a quarter and makes less than $300, you don't have to withhold. But if they're over $300 in a quarter, you have to withhold. So you can see that these rules are not very accommodating to COVID, where people are sheltering and for a long period of time. Now, the states have come out with, and we have this on our website, we have a kind of guidance around what the states have done, and many of the states, actually most of the states, have come out with policies to say, well, if somebody's sheltering during COVID, well, we're not going to treat that person as actually having changed their tax home state, and you don't really have to withhold taxes. That doesn't adhere to the state law. That's not what the state law says, but if the state is going to give you that dispensation, you know, you can take it. Where the challenge comes in is, when we did the polling at the beginning, we did that with intention to say, well, how long do we think this is going to last? Once COVID is over, I don't think telecommuting is over. We're seeing a massive shift to allow employees to work wherever they want to work for companies that can accommodate that. And that could be technology firms, service firms. I mean, I can tell you right now, it is very, very difficult for me to find lawyers with an accounting background that want to do tax work in San Francisco. It's like finding a Yeti. And I've found many of those people in a variety of different places across the country that have that kind of a background. So we hire great people locally here in San Francisco, but on occasion, I want particular people to do particular things, and they may not be directly in my office. I myself, on my team of 20 people, have 7 of them that are remote, one of whom is going to Tunisia. So we have to deal with all of those rules, all right? The policies can be all over the map. Many companies set a threshold of pain to say, look, if an employee is going to be incidentally traveling to a state, we're not going to withhold, even though it may be technically required. And we're going to set a threshold where we say, well, we don't want to take the risk if they're there for 5 days or 10 days or 15 days. And you kind of figure out what might make sense for the organization and what you have a reasonable way to track. And that gets back to what Nishant was talking about, is how do you track this? Because most HR systems, most payroll systems don't have a tracking mechanism. So if you have a tracking mechanism, you can mitigate the risk better. If you don't have a tracking mechanism, then your policy might have to accommodate something that is reasonable that your organization can do. One more comment on this. If you have equity-based compensation or bonuses, what California and other states will do is say, if you grant options, for example, and an employee works for 4 years and the options are exercised after that 4 years, if the person at the time of exercise is a non-resident of California, then you look at the time worked in California and the percentage during that entire period of time from grant to the stock option exercise. Well, that may mean that they were a resident of California for part of the time, and maybe you didn't track their travel back then, and they were a non-resident for part of the time, and maybe they were coming into San Francisco or California for part of that time. That metric is the measurement that California would want you to put in that person's W-2 when you're figuring out their compensation. That has to be also baked into the policy. Are you going to change somebody to a non-resident of California, have one of these events potentially occur, and then have them come back? So it's not an easy question to answer. You really have to get into all of the facts of, well, what kind of compensation do you have? How many employees is it? How long are they going to be there? Why are they going to be there? Are they going to come back? Do they travel?
Okay, great. Thank you so much, Eric. That was a great response. One other question here that I see is around, do you have an overview on the impact of the employee that has traveled outside the US but are not able to come back to the US? What may be some potential tax implications for that employee?
Yeah, that's also a really good question. And unfortunately, I don't deal with the international issues. In my role, I deal with domestic issues where people are traveling around among the states. What I can tell you is we have looked at this for our own firm, because again, I have an individual who is in Tunisia that is working. So we have to look at what the international impact is, and there are two sides to that. The question is the impact on the employee. And that may depend upon whether the employee is in a country on a visa, or if they're a resident, or if they are a citizen of that country that they're working in. And that may beget some country obligations if you stay over a period of time that requires then country tax withholding and country tax payments. Usually the countries have treaties where what we see is employees that are in a country temporarily for work, that they may be absolved of any tax withholding in that country under the treaty, so that that you only are withholding on employees in the United States. Then the question is, well, do you have to treat them as a resident of California or New York or wherever they came from when they're in that other country? I think the answer to that may be yes, because they're only there temporarily sheltering. But it's, you know, that's a question that also has some texture to it that, not being an international specialist, I can't answer, but certainly others in my firm, we have people that specialize in employees traveling among countries. So, you know, if after this you want to send me an email and I can link you up with somebody who can answer that question more directly. But it does have a similar profile to the domestic travel issue that I deal with.
Great, thanks, Eric. Thank you for that offer. A question here around UBT. So as you're doing the UBT savings calculation here, would you recommend including back office support to be included in the calculation if they are not driving revenue?
That's an excellent question too. So if you look at services performed, you're looking at revenue generating people, whereas in San Francisco, you're looking at compensation for services performed by, not services performed for a client. So San Francisco is very clear that you include everybody in the computation of the payroll metric. For UBT, not quite so clear. Usually what we do is we take everybody into account because it is more like a cost measurement apportionment around the costs of doing business and where that business is being conducted, as opposed to strictly isolating the people who are revenue generating people and not including the back office employees. But in New York City, I think there is room for interpretation on that rule, because you have this services performed that appears more linked to the revenue generating individuals. Now, UBT is also a little bit different than if you're constructing a payroll factor for corporate income tax, which is what the city has on C corporations and what many of the states have on C corporations or limited liability excise taxes like Kentucky has and some other states. In that case, when you're looking at the cost of performance for services, you look at direct costs. So when you look at those rules, you do isolate revenue generating people generally and do not include all of your back office support or people who are not client facing. So there may be a difference depending upon which tax you're talking about. For UBT, it is not a solved question for UBT. And I think there is a position both ways.
Okay, thank you. And then another question here that I see is around, can you apportion income for the purposes of UBT based on fiscal quarters instead of annually?
Ooh, that's a good question. No, I haven't done that. So I may have to think about that a bit more to give a complete answer. But you know, if you think about an apportionment, the way the rule is constructed is really looking at a tax year. So I think the law contemplates a tax year. So quarters may be, you know, maybe a bit more difficult to think about. But I understand where you're going. The first quarter of this year, we had people that were working in offices. The second quarter of this year, we had people that were sheltering in place. So you do have a big difference between the first quarter, second quarter, third quarter, fourth quarter. If you earn substantial income in the first quarter of the year, and that is your biggest quarter, then you know, and you have more employees working in New York, that may be a bad answer. If your first quarter is really down, you know, is typically a time of year when you don't earn a lot of revenue, maybe you get a good answer by doing it on a quarter by quarter basis, and that may be the genesis of the question. There is an alternative apportionment mechanism that is baked into, or a variance mechanism that is baked into all of the state and city laws that says if your construction or if your activity, the way that the apportionment is constructed does not bear relation to the result and is distortive of the result. So let's take the case where you have lots of income in the beginning of the year and people are all sitting in New York City, and then, or actually, let me take the reverse. You don't have very much income at the beginning of the year and people are sitting in New York City, and you have lots of income later in the year and people aren't in New York City. Then could you make the case that you need a variance? I don't know that it fits directly in the four corners of the law, but you may ask for a variance from that to more appropriately reflect the activity aligned with the income. I think it'd be a difficult position, but you know, maybe something to review.
Okay. We probably have time only for one more question. So if somebody has a burning question on their mind, please send that in and we'll do our best to answer it. But in the meantime, Eric, maybe a parting question here. So as folks on this call think about whether they should they should try and claim savings from a UBT or GRT. What would be your recommendation? What are the things that they should think about?
Yeah, I think this really goes back to taking a good hard look at the law and what the law provides. And I think you'll see that there's not a lot of great guidance in the city tax ordinances, but some. But then it all comes down to substantiation. How do you know that somebody was actually working someplace else? And what we have done is a variety of different things. We survey our employees. We'll look at badge data going in and out of a building. We'll look at parking records. We'll look at any number of things, any number of things that we can to get our hands on to figure out that employees are working outside of the city. I can tell you that having that data is good, but it's not great. We've done pretty decently on audits, being able to substantiate with San Francisco or come up with an agreement with San Francisco on what a reasonable reduction or a reasonable percentage of work outside of the city is. But information is key. The better your information is, the better you will have in an audit. I think you should take the position because clearly people are working outside of the city. It's worth the dollars to even pick through and figure out how much people are working outside. What Nishant talked about with a technology-enabled solution would give you very clear data. It is from third-party sources because it's not something that you're preparing solely for tax purposes. You're not asking people how much they worked outside of San Francisco and they're telling you, and that's for a tax reason. You're just figuring out how much work they did outside of the city, and therefore it drives a tax result. So I would look for ways to have third-party corroborating evidence of people working outside of the area that is the taxing jurisdiction you're looking for. Okay, and I want to thank everybody for all the questions. This is fantastic and phenomenal. I appreciate all the engagement. And Nishant, I don't know if you had any parting words.
Well, I want to thank you. This was an excellent conversation. I always enjoy this conversation, Eric. So thank you very much. And thank you to everybody for coming, joining us and listening to us. Both Eric and I will make ourselves available to the extent that you have any questions. If there's anything that we can help with, please don't hesitate to reach out. So Sean, back to you.